I want you to picture something real, not a hypothetical. A real American living room, suburban Tampa, Tuesday afternoon, March 2026. Her name is Linda. She's 68. The casseroles from the funeral are still in the freezer. Her husband, Robert, the man she married at 22, the man who worked 38 years as a regional plant manager, the man who wore the same gold wedding band his whole life, died 9 weeks ago. Heart attack. Saturday morning, in the garage, changing the oil on the Buick. Linda is sitting at the kitchen table, reading glasses on, yellow legal pad, a letter from her CPA in front of her. She's read it 4 times. She doesn't understand it. She can't understand it. Because what the CPA is telling her, in polite professional language, is that the federal government is about to take roughly $73,000 out of her retirement savings this year. Same accounts, same RMDs, same house. Last year, when Robert was alive, that tax bill was about $18,000. Robert died. Linda lost a smaller Social Security check. Her gross income dropped by almost $30,000. She's poorer, she's grieving, she's alone, and her tax bill just quadrupled. That's not a glitch, that's not bad luck. That's the federal tax code working exactly the way it's written. It's called the widow's penalty. And if you're married, if either of you has a traditional IRA or a 401k with any meaningful balance, you need to understand this right now, because nobody is going to warn you until it's too late to fix. Hit subscribe right now if you're over 60. This is exactly why this channel exists, to tell you what the system isn't telling you. All right, let's get into it. So let's walk through what actually happened to Linda step by step, because once you see the math, you can't unsee it. In 2025, Robert and Linda filed married filing jointly. Their income looked like this. Robert's Social Security, $3,100 a month. Linda's, $1,900 a month. Combined, $60,000 a year. Robert had a small pension from the company, $18,000 a year. Their traditional IRA had a balance of $740,000, and his RMD that year was about $28,000. Their taxable brokerage account threw off $6,000 in dividends. Their CDs at the credit union paid $4,400 in interest. Added up. $116,400 of gross income as a married couple. Now here's the part the IRS hides. As a married couple filing jointly in 2025, they got the standard deduction. They got the additional age 65 deduction. They got the new senior bonus deduction from the One Big Beautiful Bill. Their taxable income dropped to about $77,000, and the 12% federal tax bracket for a married couple stretches all the way up to roughly $97,000 of taxable income. So they paid 10% on the first chunk and 12% on the rest. Total federal tax bill, about $8,400. On a $116,000 gross income. That's an effective tax rate of 7%. That's the deal married couples get. Now Robert dies, January 2026, and Linda is suddenly a single filer for the entire 2026 tax year, because the IRS uses your filing status as of December 31st. There's a small grace period called qualifying surviving spouse that lets you keep the joint rates for up to 2 years, but only if you have a dependent child living with you. Linda's kids are grown. They have their own mortgages. Linda gets 0 grace period. She files single in 2026. Her income drops. Robert's Social Security check is gone. Robert's pension had a 50% survivor benefit, so that $18,000 becomes $9,000. She still has the RMD, the dividends, the CD interest. New total, about $84,000. Linda's gross income just dropped by $32,000. She's a third poorer than she was when Robert was alive. Now watch what happens next, because this is the part that should make you furious. As a single filer in 2026, Linda's standard deduction is cut roughly in half. She still gets her age 65 add-on. She still gets the senior bonus deduction. But her taxable income is now around $60,000. And here's the math the IRS never wants you to do. The 12% tax bracket for a single filer in 2026 ends at roughly $48,500. Linda's taxable income is $60,000. She has crossed the 22% line. She's now paying 22 cents on the dollar on a chunk of her income that used to be taxed at 12 cents on the dollar when Robert was alive. But it gets worse, because the rules for taxing Social Security itself also shift when you become single. For a married couple, the protection threshold is $32,000. For a single filer, it's $25,000. Linda's provisional income is now high enough that 85% of her Social Security check becomes taxable. And we haven't even talked about Medicare yet. While Robert was alive, their joint income kept them well below the IRMAA threshold. They paid the standard Medicare Part B premium. After Robert dies, Linda is measured against the single filer IRMAA threshold, which kicks in around $106,000 of modified adjusted gross income. Depending on her exact numbers, she may land in the first IRMAA bracket, pushing her Medicare premium from about $185 a month up by $75, plus a surcharge on her Part D drug plan. That's roughly $900 a year, every year, for the rest of her life, because she had the audacity to be widowed. Layer it all together: the federal tax bracket collapse, the Social Security inclusion shift, the IRMAA surcharge, the lost income from Robert's check and reduced pension. The widow's penalty for Linda is roughly $65,000 a year. Same accounts, same house, same life. One missing husband. Now I want you to stop for a second, pause this video, go to the comments. Tell me honestly, have you and your spouse ever sat down and actually run this calculation? Have you ever modeled what your taxes look like the day after one of you dies? I'd bet 95% of you haven't, because nobody told you to. Drop your situation in the comments, your state, roughly what's in the traditional IRA, whether your pension has a survivor benefit. I read every comment. Now let me give you the 4 assets you need to think about restructuring while you still have time, while both spouses are still alive. Because every one of these moves requires that both of you are still here to sign the paperwork. Asset number 1. The traditional IRA, the traditional 401k, the SEP IRA, any pre-tax retirement account. This is the biggest source of widow's penalty damage in the typical American retirement portfolio. Every dollar in a traditional account is a dollar of future taxable income. The IRS already owns a percentage. They're just waiting to collect it at a higher rate after one of you dies. The strategy is called Roth conversions. Phased, multi-year planned conversions while both spouses are still alive and filing jointly. While you're married, you can fill the 22% bracket up to almost $200,000 of taxable income. That gives you a massive runway to slowly move money from traditional to Roth. You pay the tax now at 22%. The money becomes permanently tax-free. No RMDs, no tax on growth, no tax on withdrawal. And when one spouse dies, the surviving spouse inherits a Roth, which doesn't generate taxable income at all. The math is the same total tax dollars in many cases, but the difference is you pay it at the married rate, in the wider brackets, while you're both alive, instead of having the surviving spouse pay it at the single rate. With IRMAA surcharges, with 85% of Social Security exposed to tax for the rest of her life. This is the single most important conversation to have with a fee-only fiduciary advisor or a tax professional. Not next year, this year. Because Roth conversions take 5 to 7 years to do properly without triggering your own IRMAA penalties. Asset number 2, the taxable brokerage account. This one is counterintuitive, and most generic financial planners get it wrong. They tell couples to gift appreciated stock during their lifetime to reduce the estate. For most middle-class couples, that's actually the wrong move. The reason is Internal Revenue Code Section 1014, the step-up in basis. When a spouse dies and leaves appreciated assets to the surviving spouse, the cost basis of those assets resets to fair market value on the date of death. All the built-up capital gain disappears. The IRS forgives it. So if Robert bought $100,000 of an index fund years ago, and it's worth $240,000 when he dies, Linda inherits it with a fresh cost basis of $240,000. She can sell it the next day. Zero capital gains tax. The $140,000 of built-in gain is forgiven. But, and this is critical, it only works if the asset is titled correctly at the time of death. In community property states like California, Texas, Arizona, Washington, Idaho, Louisiana, Nevada, New Mexico, and Wisconsin, jointly held community property gets a full 100% step-up. In every other state, if the account is held as joint tenancy with rights of survivorship, only the deceased spouse's half gets the step-up. The surviving spouse's half keeps the original basis. The fix is to talk to an estate planning attorney about how your taxable accounts are titled. Depending on your state, you may benefit from a joint revocable trust with specific provisions, or different titling structures. This is not a do-it-yourself project. Wrong titling costs surviving spouses tens of thousands in unnecessary capital gains tax. Right titling costs you a few $100s in legal fees. Asset number 3. The pension election. This is the silent killer. Most company pensions by default get paid as a single life annuity, unless the retiring employee specifically chooses a joint and survivor option. Single life pays a bigger monthly check while the retiree is alive, and zero after they die. Joint and survivor pays a smaller monthly check but continues paying, at 50%, 75%, or 100%, to the surviving spouse for the rest of her life. Federal law actually requires the non-employee spouse to sign a notarized waiver before single life can be elected on a qualified plan. Most people sign that waiver without understanding what they're giving up. If you're pre-retirement and haven't started drawing yet, strongly consider electing the highest survivor percentage you can afford, even if it means a smaller monthly check. The math almost always favors the surviving spouse in the long run. If you're already drawing single life and locked in, you can't reverse it. But there's a strategy called pension maximization. You buy a permanent life insurance policy on the pensioner, sized to replace the lost income stream. When the pensioner dies, the surviving spouse gets a tax-free death benefit she can use to buy an immediate annuity or invest. Federal law treats life insurance death benefits as income tax-free under Section 101A. This strategy isn't right for everyone. It depends on the insurability of the pensioner and the cost of the policy versus the pension differential. Run the math with a licensed insurance professional and a fee-only fiduciary advisor. Get a second opinion before signing anything. Asset number 4. The high-yield CDs, money markets, and taxable bond portfolio. Most retirement-age couples have somewhere between $50,000 and $300,000 in CDs, money markets, or taxable bonds, generating interest every year. That interest is fully taxable as ordinary income. While both spouses are alive, the interest is absorbed inside the wider married brackets. The day one spouse dies, that same interest gets pushed into the narrower single brackets and can push the survivor across an IRMAA tier. 3 potential fixes to discuss with a tax professional. 1. Replace some CDs with high-quality in-state municipal bonds. The interest is exempt from federal income tax under Section 103 and exempt from your state income tax. 2. Shift cash into a multi-year guaranteed annuity that compounds tax-deferred, so the interest doesn't show up on a 1099 every year. 3. For some high-net-worth couples, properly structured cash value life insurance can defer tax on growth. Each of these has trade-offs. None are right for everyone. The strategy depends on your state, your tax bracket, your liquidity needs, and your health. Don't pick one based on a YouTube video. Run it with a fiduciary. Now look at what you've done if you executed all 4 moves before the first spouse died. The traditional IRA was converted to Roth. The surviving spouse inherits tax-free money. The taxable brokerage was titled correctly. The survivor gets a full step-up in basis. The pension was elected as joint and survivor or replaced through pension maximization. The survivor gets a continued income stream. The CDs were restructured. Recurring interest income is reduced or removed from single-filer tax exposure. The widow's penalty is largely defanged. In Linda's case, instead of $65,000 to $73,000 a year in extra taxes plus IRMAA penalties, she might pay closer to $10,000. Same gross income, different account architecture. Multiplied over a 20-year survival, that's well over $1 million of preserved wealth. The window to do this work is narrower than most people realize. Roth conversions take 5 to 7 years to do properly. Pension elections are usually locked once you start drawing. Life insurance requires underwriting. Both spouses need to be healthy enough to qualify. Trust restructuring requires both spouses to have the legal capacity to sign documents. If one of you is already in declining health, half of these tools are off the table. Here's your 3 steps for this week. Step 1. Sit down with your spouse tonight. Open a notebook. Write down the 4 asset categories: traditional IRA, taxable brokerage, pension election, CDs and bonds. Write down what you have in each. That's the starting point. Step 2. Find a fee-only fiduciary advisor or an estate planning attorney who actually understands the widow's penalty. Not a generic broker, not someone trying to sell you a product. Someone who charges by the hour and has no incentive other than running the math correctly for your specific situation. Step 3. Share this video with one married couple you care about. Today, not tomorrow. One conversation tonight between 2 spouses still both alive can save the surviving one of them 6 figures over the next 20 years. Look, I'm going to be straight with you. The widow's penalty isn't a secret. The Joint Committee on Taxation has known about it for decades. Brookings has written about it. AARP has covered it. The information has been sitting in plain sight. Every Congress that's had the chance to fix it has chosen not to. Why? Because the widow's penalty generates billions of dollars in stealth federal revenue every year. There are roughly 800,000 new widows and widowers in America annually. That math adds up fast. This channel exists to make sure you walk into your retirement decisions and your spouse's death with your eyes wide open. The tax code contains the trap. It also contains the escape hatches. You just have to know where to look before the funeral. If this video helped you, hit the like button so YouTube shows it to more people who need it. Subscribe so you don't miss the next one. And share it with one couple tonight. In the next video, I'm walking through how to actually run a multi-year Roth conversion plan, including the year-by-year math, the IRMAA tripwires to avoid, and the conversation to have with your CPA. Make sure you're subscribed. I'll see you in the next one.